What exactly is liquidity? Liquidity is just nature of liquid. Being liquid refers to flow. How easy things can flow. Like, yeah, be water, my friend. Like, easily move around. That's what liquid means. So what does liquidity in finance means? By definition, proper definition, liquidity refers to how quickly and easily a financial asset or security can be converted into cash without losing significant value. In other words, how long does it take to sell? So this is basically, like I said, what does liquidity means? Easily move around. So whatever asset you have, how easily it can be sold, that defines its liquidity. Easy if it can be sold easily, it's more liquid. So let's just discuss it further. So what is liquid and what isn't? We have liquid cash. By liquid cash, I mean legal tender. So for example, Indian rupee in India and US dollar is the reserve currency. So it's for the world. So transaction happening in India, like all the other transactions which aren't taking place with Indian rupee are considered illegal. And like making a legal tender makes the currency more liquid. Like you can buy anything with Indian currency in India. So the cash is liquid here. Yeah, the more and more people are willing to exchange their goods and services for cash, and yeah, cash becomes liquid. So what isn't liquid? Petrol, for example, we all know like petrol has use cases, but it isn't liquid. Liquid as in terms like, yeah, let's take example. I can't buy my gym membership with petrol. Like I can't give petrol to my gym owner, ask him to give me membership. So now here I have to find someone who's willing to exchange cash with me for the petrol, and I can use that cash to pay for my gym membership. So like yeah, petrol is liquid just for it to be converted into cash. But here petrol can't be used to transact with any other deal. So gold is highly liquid as everyone is willing to exchange with it. Yeah, it's simple. Like gold is like God's money. So two most important things for any business are liquidity and volume. We will discuss in detail liquidity and volume. And yeah, before we move further, the key point is there are two types of businesses, business of making money and business of ownership. Keep this in mind. We will use these two both and build on this. So like ever wonder why a normal tea vendor shop sells tea for 10 bucks and this tea or coffee for 10 bucks and some coffee shop in a mall or airport sells it for 350 bucks? Or ever thought like why a water bottle costs 20 bucks at a normal shop, 60 bucks at a movie, 200 at an airport? Yeah, or like ever thought like cab is charging different prices at different times of the day, but the distance is same. Ever thought like why some shops give discount during festival like Diwali, and some shops sell the same sweets at a premium price on the same festival. So like discount and premium in different places, but same occasion, same reasoning. So yeah, the examples which I took just now are examples of liquidity and liquidity volume, time liquidity and time volume. So yeah, let's get into that. So we will use examples to understand the fundamentals. Like we have to understand the very core principles, then only we can move to the charts. Yeah, like things like yeah, let's understand the fundamentals, what makes anything a business, and trading is a business. So let's understand it in the business terms. So yeah, we will come back to charts in the later part, but yeah, just understand the core principles now. Everything we humans do run on the simple fundamental of an auction, and it works on the simple principle: you give people what they want, and they will give you what you want. Just pure auction. Like that's how humans work. So different business have different goals. Some business tend to do more volume. Some business prefer to do low volume, but grab it at a higher prices or the lower prices. That's all. So let's example housing finance. Yeah, we all know housing finance, buying, selling properties. But like housing finance gets more complicated than that. Housing finance is the most illiquid market. So let's consider someone says like, yeah, in this area, average house price is like $60,000. But yeah, is the price actually $60,000? They just say if someone wants to sell his house, and yeah, obviously people sell their houses when there's an urgency. So you go to the market or like and you do all the process stuff, and now you need to find a buyer at $60,000. No one's gonna buy at $60,000. You are desperate to sell because there's some need and stuff. So you have to give discount till you find a buyer. And yeah, now you give a discount of $10,000. So now you found a willing buyer who is willing to buy the same house at $50,000, and he sells the house. So like now, if you want to buy a house in some area, and you are in an urgent need or desperate need to buy it, and the market price is currently like people say it's around $60,000, but when you go, no one gonna sell you at $60,000 because people don't buy houses to sell. So it's a safe asset, some sort of. But yeah, So you have to make the offer tempting. So whatever the market price is, you have to pay a premium to make it more tempting for the another man to sell it. So you bid a house, you make a bid at $70,000, and the other seller likes the deal, and you take the deal for $70,000, and the house is yours. The problem with housing finance is that the price is always like way too valuable. Like okay, you have to give discount to the buyer when you're buying a house, and you have to give a discount when you're selling. Yeah, so like it's basic auction. One is like there's a market order of like $50,000, and there's a market order of, sorry, there's a limit order of $50,000, and there's a limit order of $70,000. And you being like a desperate buyer or seller, you just have to reach those extremes to make the buy and sell option, buy and sell thing to happen. Like to understand this better, you can watch the previous video, auction market theory, how exactly price moves. So basically, like there are two orders there. You just move from current price to there to fulfill the orders. Yeah, basically everything works on fear and greed. So gold and US dollar. Whenever you see gold charts, they are pretty volatile. Like they are more going up and down for the same reason. There's a little bit lack of liquidity compared to other shares. So does that mean housing finance and gold finance are the same? No, actually, there's a big difference between also housing finance and gold. The bigger thing is housing finance lack volume, whereas gold and US dollar doesn't. Yeah, like gold, people are always transacting or buying gold, and US dollar is the reserve currency. So all over the world, there's always a demand and supply of US dollar. So there's a constant exchange of gold and US dollar. So there is never lack of volume there. Sometimes aggressiveness increases. That's what increases the volatility, demand, and supply stuff. But yeah, what housing finance and gold, the major difference is volume. In one place, the volume is lacking, and the place there's too much volume. So what's the difference between volume and liquidity, as we discussed above? Yeah, both are sides of the same coin. So like let's take the correlation. Like when the volume is high and liquidity is low. Sorry, yeah, when the volume is high, liquidity is low. The markets get too volatile. Low volume, low liquidity, we are in a range. High volume, high liquidity, we are in a range. But low volume and high liquidity, flat market. Yeah, like there are always there's liquidity, and every market order gets absorbed instantly. Like there's liquidity, like there are already people interested to buy. If you are in urgent need, you will get filled in the spot. So yeah, there are like three types of liquidity: time-based liquidity, volume-based liquidity, and price-based liquidity. Let's start with time-based liquidity. So we will take an example. When you go to a vegetable market, many people will be there at starting of the market and at the closing of the market. As I discussed in the previous video, auction market theory, what is the tendency of a buyer and seller at different times? Yeah, so like at the start of the market, yeah, he wants to like, yeah, let's make a good start, sell it. And the buyers are like, yeah, fresh vegetables, we will buy more at the start. At the end of the day, like people like just want to buy it. Just get anything you can get now. Like as you're late, it's closing market, just buy anything. And the vegetable sellers are like, yeah, it's closing hours, so like just take anything you can. So like the volume is high during open and close. So this time-based liquidity means like open and close are the times where you can see high volume taking place. So it's like volume-based, sorry, it's like high volume. So like time-based liquidity, like it's dependent on time, open and close of the market. So where can you see this kind of liquidity? Yeah, open close of all sessions, New York session, London session, or regular trading hours of whatever markets you are trading, be it like bond market, stock market, crypto market, any market for that matter. So yeah, so these are the liquidity I use, time-based liquidities. So yeah, these are in terms of UTC. So when if you are marking or creating the sessions, do refer this. So volume-based liquidity. Volume-based liquidity is the most essential type of liquidity. And what all liquidities are like a subset of volume-based liquidity. Volume is like everything in the market. So as I discussed, there are two types of businesses. One is like volume, like ownership, and other is making money. So both needs volume. So all types of liquidity are categorized into volume-based liquidity, can be categorized. Yeah. So even time-based liquidity or volume-based liquidity. Yeah. So let's consider an example. Let's just say I have a toy shop. So I'm selling a toy at $350. and people keep buying it. Like there's huge volume, huge demand at it. So what I'm gonna do, like increase the price by 5%. Now I'm selling the same toy for 380 rupees or 380 bucks next day. So like if I see like less people are buying at 380 and compared to the number of people that were buying at 350, so I will come back to the lower prices because as a seller, like I'm selling, it's like it's pure selling option, a selling auction. I want to give away the volume of toys I have. I want to sell them as quickly as possible, but also at a good margin. So if I see there's a volume drop at 380, so what am I gonna do? I will come back to 350 as I want to get rid of the inventory I have. So I come back to 350 when volume was taking well. So I come back, set the price 350 the next day. I see there's an increase in the volume. So like more and more people are interested now. So I will try to increase by 2%, 3%. Yeah, we'll test like are there still buyers at higher prices. So this is how like volume-based liquidity works. Yeah, we went from 350 to 380, but there was a lack of buying interest, so we came back to 350. What 350 became, it was our previous volume-based liquidity as there was more volume. In charts, you can call them like high volume nodes or POCs, price-based liquidity. So yeah, this is like one of the most common and common thing. It's like a price is like purely price. Whatever price you are seeing is the volume at it. Like usually, if you're trading BTC, price-based liquidity can be at 60K, 70K, 65K, or like the previous all-time high, a main number 69,420. Or like if you're trading on Nifty, like 23,500, 25K, 26K, any number like which are like more attractive or in multiples of thousand or a complete number. So those are like the key points where you see, yeah, 25K is a good level. Like, yeah, like it's a quarter of 100K. So like good number. So it's just price based. There's no logic to that. It's just price 25K. Like it even sounds like a good level, 25K. So yeah, you can consider that as a good level. So like there's no logic in that, but if you see volume there happening, it becomes a good level eventually. So yeah, let's take example of a tea seller. So yeah, let's take an example of a normal regular tea seller. Before COVID, yeah, this time I will use the charts to explain this. Yeah, let's say this shop killer used to sell a glass of tea for $8, but suddenly COVID started, and no, like very less people were willing to buy at eight. So what are you gonna do? Give a discount, attract more buyers? Yeah, so he tried at seven, six, then yeah, finally he reached five, and people were willing to buy at five. So he saw there was a growth in volume, and lockdown started to open. So he started to move price from like five to six, seven, then eight. Eventually, like he brushed the price from five to eight. Yeah, and there was a obviously you are like hiking up the prices. You will like usually see like there is lack of buying interest. So you go a point below like $7, you see yeah now the buyers are more interested. You stay there for a while, then slowly you increase back to it. You see like yeah obviously now COVID is over 3 years out of COVID inflation stuff. Yeah, now you see more buyers again. Then you start moving up. Oh yes, at nine you see there's still volume high. Then you reach 10, and yeah, there's a lack of buying interest. It's selling less tea, so you start giving like you just say if something triggers again, another lockdown, another COVID, something sort of, and just suddenly there's like lack of buying interest. What's gonna happen? Where you wanna go? How much discount you should be giving? We go back to the previous level nine. Yeah, still there's still lack of volume. Eight previous price where we started before COVID. Yeah, it's not holding. Like there's not enough volume to buy. Like there are enough. There aren't enough buyers coming in. So where do we go? We go point below seven. So you see this thing here, like seven, six, five. You directly rush from five to eight and then came back to seven. So now what does six become? Six becomes a fair value gap. Obviously, like yeah, close of it here, close of it here, and this becomes a fair value gap. So price come back, tapped into this. Yeah, previously like there was aggressive buying at this price. This was a fair value gap. So like people weren't willing to like hold that price. People were like, yeah, keep it coming. Like there was a high volume, and we kept pushing up. So when what this is what happens when you tap into a fair value gap. Because yeah, previously there was no interest of sellers, or like say there is no interest of going down, or there was a hike in volume. So next time you visit such areas like fair value gap, so you tend to go up from there. So this is why fair value gaps or the single prints work, which I will be discussing in future videos in detail. But you get the logic why fair value gaps and single prints work. So yeah, so we get rejected from that, and we back at 10 rupees. So this is basically what happens in the market. And there's one more thing you absorbed. Like I didn't use the term like sellers are entering. Usually like markets are two-way auction, but this you are a shopkeeper and you want to sell your products. So here it's only a sell side auction. Sorry, only a buy side auction you are looking at. So this is a pure buy auction, and but you see how lack of buying interest, you see lack of buying interest drop the price, lack of buying interest drop the price, lack of buying interest we drop the price. So you see, I didn't even use the term sellers here, but yeah, lack of buying interest has still lack of buying interest can tempt price to go on a discount. When this happens, it's where sell side auction take place, and sellers can make most of it. Well, of course, in the open market where both side auctions are taking place, this is an example of only buy side auction. But when both auctions are taking place in an open market, when there's a lack of buying interest, sell side auction starts taking place. Sellers try to make the most. Yeah, lack of buying interest. Sellers look at the opportunity. They're like there aren't enough buyers there, some sort of stuff. Yeah, they take it, take advantage. Same stuff. So this happens on all time frames in all markets. Obviously, it's just pure auction, so it's going to happen everywhere in all types of market. So basically, this is pure fundamentals in normal business. But when you look at in charts in this way, it will be more clear. So now you know, like basically how to spot liquidity, equal highs, equal lows, previous fair value gaps. I like explain the logic how you can spot the liquidity areas and what exactly liquidity means. When you look at charts, you are just watching other humans. Charts are just representation of human nature. So whatever I discuss in the charts, it's just pure logic of how humans work, and everything boils down to like you give people what they want and they will give you what you want, and that's all auction. Hope the liquidity concept is clear. In next video I will try to cover auction market theory and connect it to order flow. Then later on when we move to charts, we will discuss how to spot liquidity on the charts using order flow and our basic candlestick charts. So, of course, do subscribe, like, and share.